Well, the housing market is even cooler than being cool is even cooler than being cool. It's take that and square it, because the housing market is in a goddamn ice age of its own right now. And that was even further confirmed yesterday. So yesterday, the National Association of Realtors came out and released their data on existing home sales in September in the United States. What's up, apes? Welcome back to another edition of the 𝗙𝗟𝗡𝗚's Daily Podcast of the Day. Thank you all for joining us here once again on the world's most popular, most influential, most envied, handsomest podcast in the entire world. It is currently 7:08 p.m. on this beautiful Wednesday, October 23rd, 2024. We're very happy that you're here with us, and we hope you had a great day yesterday. I am certain that you had a better day yesterday than the WSO Alpha portfolio did, and especially better than the analysts that now used to work for the WSO Alpha portfolio. Horrible day for the apes. We were down 1.4% for the session, and it's all because of one individual ticker that we're going to be talking about in just a quick second. And I'm still very bullish on that ticker, but holy shit, it was a real kick in the balls for the session here yesterday. So once again, the Alpha portfolio is down 1.4%, aka 140 basis points for all you fucking losers out there. We still managed to outperform the Nasdaq, which was down 160 basis points for the session. Very rough day for big tech, except for some chip stocks that we'll talk about in a quick second. The WSO Alpha portfolio, the S&P 500, it's easy to confuse the WSO Alpha portfolio and the S&P 500, but the S&P was down 92 basis points for the session. The Russell was up 91 basis points, so similar performance for small and large caps. Then not that anybody cares, but the Dow was down 96 basis points on the day. So that brings the WSO Alpha portfolio year-to-date return to about 11.99%. Relatively weak performance compared to these indices, but still above the average annual return that you would get from holding these index funds. So not necessarily something that we're happy with, but it's not something that investors aren't pulling funds out right now. We're not going to shut down the portfolio anytime soon. So that's kind of what we're looking at. Let's go ahead and dive into some of these banana bits. So first and foremost, actively going on right now is the 16th annual I Hate America Summit, aka the 16th annual BRICS Summit, being held in Kazan, Russia. This is a small Russian town I believe it's in the southeast portion of the country, because I'm an expert on Russian geography, obviously. But this is those 36 countries that make up the BRICS. The actual name BRICS stands for Brazil, Russia, India, China, and South Africa. Jesus Christ. But yeah, so that's what's going on right now. It seems that the ultimate goal of BRICS is to de-dollarize the international trade system, which is, wouldn't necessarily be ideal for American interests, but then again, is it really that bad of a thing? What that would do is basically weaken America's ability to influence other countries on a domestic and an economic basis, but, not necessarily on a militaristic basis. But does that also give us less responsibility for the rest of the world at the same time? Either way, it's not necessarily something that we want to happen, but it's not as huge of a deal as everybody's making it out to be. Plus, they're not replacing the US dollar as the global reserve currency, at least in the next decade or so. So, if you're worried about that, don't be. At least not yet. Maybe in a couple of years. Also, if you happen to be an NBA owner, you should definitely be worried as well, because nobody's going to want to go to your games anymore unless your team is playing at the home stadium of the LA Clippers. So, Mr. Steve Ballmer, many of you might know, former CEO of Microsoft, he's the owner of the LA Clippers, and he just spent $2 billion building a brand new stadium. Now, there was a bit of an issue when he was building the stadium, because a neighboring theater called the Forum Theater was worried, like, hey man, this stadium that you're building is so sick that I'm going to start losing a ton of business over at my theater. So what did Steve Ballmer do? He just went ahead and bought the theater for $400 million and squashed that problem right there. So really spared no expense. There's 1,160 toilets in this stadium. So very good stadium when it comes to bathroom health. That means there is roughly one toilet for every 15 seat in the stadium, which is more than double the average at all other NBA games or all other NBA stadiums. So shout out to Steve Ballmer for, taking care of the fellas out there. All right, moving on down. The most underrated chip stock on the entire market right now, Texas Instruments, absolutely killed it in the second quarter. Meanwhile, IBM certainly did not. Very weak performance in its consulting and infrastructure segment, brought shares down after hours. Starbucks had relatively weak earnings as well, but the CEO came out with a commitment to simplify the menu. I feel like I'm back in high school reciting my memorized lines from Romeo and Juliet when I'm placing my girlfriend's coffee order. So very glad to see that right there. That would be a huge help for me and all the other low IQ fellas out there. Next up, we have infamous Tesla bear. Many of you might be aware of David Einhorn. I'd be surprised if a lot of you younger apes were, but he I mean, he made a name for himself being a great hedge fund investor. He's run the, I believe it's called Green Light or Green View. I think it's something like that. It's the firm that had that whole drama around the head of macro bullshit back in the day. But either way, David Einhorn, way back in the day, going into the 2010s, was a noted Tesla bear. He really became, like a regular on CNBC for that position. Obviously, didn't work out super well, but now the guy is fired up on Peloton shares. Very bullish on them, and the stock was up 11% after he came out with positive comments. Meanwhile, the Department of Justice is giving a bit of a heads up to Elon Musk. They're like, hey, buddy, what you're doing with these $1 million payments for people who sign this pledge is probably extremely illegal in terms of federal campaign finance laws. Now, the law explicitly states you can't pay people to vote for a certain direction or to influence their vote in a certain way. Now, what Musk will say is, I'm not paying people for their vote, I'm just paying them to sign this petition. But obviously, signing that petition, it seems like the purpose is to influence their vote. Now, I'm not a lawyer, I'm not a judge, thank fucking God for that, but it seems like a pretty clear violation of the law, if you ask me, and I'm somebody who likes Elon too. Anyway, finally, we have a new entrant to the most intense war going on in the entire world right now, the streaming wars, and our latest entrant into the battle. I'll give you $1 million if you can guess it. Ready? 3, 2, 1. Chick-fil-A. Chick-fil-A started a streaming and entertainment app. It's going to have things like videos that feature its fucking cows. Apparently a cow is like a logo at Chick-fil-A. I don't know why it's not a chicken, but apparently it's a cow. And recipes and all this other, I really don't understand, random bullshit. It seems like it's a thing for parents and kids for the most part. But either way, it's just corporate America trying to take up as much of your attention as humanly possible. Okay, let's go ahead and move into our big story of the day. So today for Macro Monkey, we were talking about a question that I'm sure you all will know the answer to right off the top of your head. And that is, what's cooler than being cool? And if you didn't just scream out ice cold, then kindly stop this video and go listen to Hey Ya by Outkast. Now, Hey Ya by Outkast was released in 2003, but it actually does a pretty decent job of describing the housing market in 2024, especially when he says, what's cooler than being cool? Ice cold. Well, the housing market is even cooler than being cool is even cooler than being cool. It's take that and square it, because the housing market is in a goddamn ice age of its own right now. And that was even further confirmed yesterday. So yesterday, the National Association of Realtors came out and released their data on existing home sales in September in the United States. 85% of home sales in the US are existing homes. So this is existing homes, not ones that were just built. You're not the first person to take a shit in this house or to buy this house, in other words. And I think first person to take a shit is a huge premium on a house, by the way. But 85% of houses sold in the United States are existing homes. Now, we know that the housing market has been completely frozen since, really since 2005 and shit, but started to come back alive after about 2011, 2012, hit a recent peak back in 2021, and it's been nothing but downhill since then. Barely any activity going on. Believe right now there's still, like 7 realtors in the country for every actual listed property, so that's probably a fucking grand old career to get into, not competitive whatsoever. But still, the housing market in the United States activity has been so depressed, and it only got worse in September. So last month, according to the National Association of Realtors, aka the NAR, there was a total seasonally adjusted annualized rate of 3.84 million homes sold last month. Now, that's a 1% decline from August, and actually marks, this actually keeps 2024 on track to be the single worst year for the U.S. housing market since 1995 in terms of total turnover. Basically, the total amount of sales. This is going to be the worst year since 1995. Absolutely unbelievable. Basically a 30-year low that we're seeing in 2024. And actually, August itself with 3.84 million homes, that was the lowest in a single month that we've seen since October of 2010. So in, almost 14 years at this point? Crazy low numbers we're talking about here, and that's from both the demand and the supply side. So what's going on here? Because originally, post-pandemic, obviously demand for houses exploded because of the work from home stuff and extremely low rate. So people were buying and selling this stuff like hotcakes. Meanwhile, a couple of years later, 2022, 2023, when rates started to increase, obviously that disincentivizes home owners who have a mortgage rate below, 5, below 4% or so, from selling and moving their property because they're going to have to double their interest rate effectively. I mean, I think about 75% of homeowners in the United States have a mortgage rate under 5%. Why the hell would they want to move if they're going to get a higher rate on a probably more expensive house? Because most of the time you want to be moving up unless you're retiring and you're downsizing from that point. So long story short, a lot of people thought 2023 was going to be, or thought 2024 was going to be a year of recovery from the trough scene in 2023. This was an especially popular thought process because of the decline of interest rates. So when Powell started cutting rates in September, now realistically, the market started cutting rates back in January because of the Fed's tool of forward guidance saying that we're going to be cutting this year. So we've seen mortgage rates on the decline just about all of 2024, but it's certainly not making enough of a difference to actually convince wannabe buyers to go through and pull the trigger on a mortgage application. So as we kind of continue to think about exactly what's going on here, it's really just that affordability crisis, and it's not just the value of homes, even though the value of homes are still at an absolute peak, or according to the Redfin data, they peaked in about June or July of this year. But this stuff is getting housing data is quite the challenge. But nonetheless, even though mortgage rates have declined a little bit this year, they are actually back on the rise. So on September 26th, they hit a recent low of 6.08% on 30-year fixed mortgages. Meanwhile, now they currently sit at 6.44%, a 6% gain in mortgage rates in just under a month or so, right? Yeah, just under a month. Now, if that's not bad enough for you, we can go ahead and talk about some of the other costs that wannabe home buyers would be or are facing. So one of the biggest things is the increase in insurance costs. We talked about this recently, but for the average American, insurance costs on your home are up about 30% since the end of 2019. That slightly outpaces the rate of inflation that we've seen since then. So insurance increasing faster than inflation. We all know what's going on with inflation. Anyway, the cost of living is increasing by an egregious amount here in the United States. Now, wages have done a pretty good job of keeping up with that. When it comes to the housing market, your wages are going to matter in a different way than you necessarily think. So although median income in the United States has been increasing, what's increasing a lot faster is what's called qualified income. So when you buy a house, you have to, basically what they want to determine is that you have enough income to actually make these mortgage payments with the expected costs, at least at the time of your application or at the time of your signing. So qualified income has increased much, much faster than that of actual income. And so that means the requirements to even apply for a mortgage are going to be a lot higher than they were pre-pandemic. So the need for higher income, and at the same time, it's the double whammy of the need for higher income while costs are also rising. And so, those are going to squeeze buyers, and obviously we can see why demand is retreating a little bit. And we always talk about the supply side. We always talk about this with new residential construction data. The only way to fix this is going to be through building new houses, bringing down affordability, because that is the big problem right now. Affordability is still basically at an all-time low. It's up a little bit since lows that were reached back in June and July of this year, but it's still basically at an all-time low. This is a huge problem, not only economically, but for society as well. Now, it might not be a huge problem right now, but if this kind of trend plays out over the next, couple of decades or so, these issues compound. And so on the economic side, home ownership has been one of the biggest, if not the key to developing long-term cross-generational wealth here in the United States. It's forced compounding. It's a forced savings vehicle. So this has been what's allowed a lot of people in the United States to create economic wealth for themselves. Meanwhile, on a societal basis, home ownership is absolutely key to a functioning society, at least because that's kind of been built into our DNA here in the United States. Now, other economies, especially in Europe, have more of a tendency on renters. Like, they've been built on a renter economy, so they're kind of more used to this stuff. But here in the United States, we're an ownership economy, at least when it comes to housing and shelter. And so that changes quite a bit. Owning property, this kind of forces citizens to have more skin in the game in their local community, and thus care a little bit more about what's going on, and be actually invested in both their local and their national community to maintain their property value over time. And kind of makes you start to understand why the founders only wanted property owners to vote. Now, obviously, I'm going to say that because I just bought a house, so that is actually my position now. If you don't own a home, I don't want you to fucking vote. But I can start to understand that a little bit. I mean, I'm only one mortgage payment deep at this point. Got the second one coming up in a couple of days. So, I don't know, maybe we can start to take some odds on when that first foreclosure notice is actually going to hit. But I certainly hope that, the rest of the market finishes itself, because I don't want you guys to be in as fucked of a position as we are. Okay. With that said, let's go ahead and move into some of our big stock movers of the day. Our first What's Right name, this is going to sound awfully familiar to anybody who's listened earlier this week. We have Spirit Airlines up 45.97% on the day. And it was up 53% just yesterday or a couple of days ago. Let me go ahead and check its 5-day return. Yeah, in the past 5 days, it's up 87.8%. Now, in the past, oh my God, Jesus Christ. In the past year, it's still down 81.28%. I mean, the stock trades at $3.08 a share. It's up, since its recent low, we're up 109.52%. So that's since, Jesus Christ, that's since Friday alone? Yeah, so since Friday of last week, the stock is up almost 110%, more than doubling in that period. There's been a lot going on with this company. First and foremost, the 53% return earlier this week was largely driven by the fact that Spirit isn't going bankrupt. And that was really it. They bought themselves some extra time to not go bankrupt until around Christmas time later this year. But today, the news changed up a little bit. So it turns out Spirit woke up off of its deathbed and actually stepped into a potential marriage. So we know where this whole debacle kind of began was when JetBlue kicked Spirit to the curb and said, yeah, that's a walking problem, walking liability. We do not want to add that to our business. But Frontier Airlines seems to think a little bit different. So Spirit and Frontier are currently actively engaging in merger talks. They're just talking at this point. It's nothing official just yet. Spirit doesn't want to put a label on things after its traumatic relationship with JetBlue. So it's understandable, but investors were fired up to see that somebody might actually want to still buy this thing. Moving on down below into AT&T. So this is another one of America's most hated companies. Shares were up 4.6% on the day. It's really tough to decide which shitty, bad customer service, broadband, and cell provider you want for your house. We have a couple. They're equally as garbage as each other, but it was no question in the third quarter who won, and that was absolutely AT&T. The firm beat on its EPS estimates and still actually missed on sales, but really nobody cared. Everybody was distracted by the huge 403,000 additions to postpaid accounts for AT&T, destroying estimates. Postpaid, by the way, is a huge market within the telecom space, so that's why they pay a lot of attention to it. Churn declined just about across the board, so did ARPU. So all in all, good quarter for AT&T. The only bad part was they did have a $4.4 billion goodwill impairment charge, and this is related to a lot of businesses are canceling their voice networks because we have Zoom now, so they don't really need this, conference like phone call software because it's all done on video calls now. So a lot of companies are starting to cancel this. That was a $4.4 billion goodwill impairment charge, but even still, adding that back in, the company was able to deliver $5.1 billion in free cash flow, easily beating estimates for $4.7 billion. All right. Moving down into our stinky, rotten movers of the day. We have Enphase Energy, and I got a fucking bone to pick with this company right here. So Enphase Energy shares were down 14.92% on the session. That's what absolutely destroyed the WSO Alpha portfolio. It's why I just turned a bunch of, former analysts for WSO Alpha into homeless people, firing them the second that I saw this earnings report. But if Enphase Energy is going down, they're taking the entirety of the solar sector with it, and that is exactly what happened on Wednesday. So Enphase, once again, down 14.92% on the session. This is a maker of solar panels, by the way, and really solar inverters is kind of their main business that go into the photovoltaic panels. No big deal, I know big words. But the company came out here and reported earnings per share of 68 cents per share on $380.9 million in revenue. Estimates were for 71 cents per share on $392.6 million in revenue. If you're not too good at math, their actual numbers were less than their estimated numbers. So obviously that completely walloped shares. But the real disappointing aspect and the reason it was down so much was because of Europe. So we spent most of the conversation yesterday talking about how fucking dope the US is compared to Europe, and Enphase Energy is living that reality right now. So US sales were up 43% compared to Q2 of 2024. They're still down from Q3 of 2023, but meanwhile, revenue in Europe fell 15% quarterly on what the CEO called a, quote, further softening in demand. So in the United States, we've been able to figure out our supply chain and inventory problems. Apparently can't say the same for Europe, at least in the solar market. So purchasing managers were much more willing to increase the volume of their order sizes last quarter because things had slowly started to normalize in Q2, at least here stateside. Meanwhile, like I said, the same can't be said for Europe. So that's why you're seeing weakness, and because the company said further softening in demand, that obviously paints a bad picture for the next quarter. Okay, moving on down into our final rotten mover of the day. You might have heard of this company before. Coca-Cola was down 2.07% on the day. So Ozempic sales are up, but sugar brown water sales are very, very down. Sales fell 1% compared to last year, which isn't really very, very down. But unit case volume was down across the board. So I'll call that very, very down. Now, keep in mind, sales were down 1%, unit case volume down 1%, and prices were up 10% at the same time. So, very weak quarter for Coke. It was really its bottling segment was hurt quite a bit. The actual sale of concentrates, held up decently well. Once again, bottling and demand out of, once again, Europe, Middle East, and Africa. So Europe is really causing a whole lot of problems for these companies, especially those in the consumer-facing sectors like Coca-Cola and like 𝗏𝗏𝗏. Personally, this will be another reason for Harvard to send me my MBA over here, but it's got to be sent as an NFT. My advice, just throw cocaine back in this stuff. I mean, it seemed like all was going well back in the 1910s and 1920s. Maybe it's time, just like, when Zuckerberg wanted to call it the Facebook, maybe it's time to drop the cola, just Coke. Maybe that'll solve the problem. I don't know, but send me my MBA when you get a chance, Harvard. All right, moving on down into our Thought Banana, our final story of the day. We got a big one for you guys today. The company reported earnings, probably our favorite company over here at WSO, especially if you check the forums. Tesla Inc. officially reported earnings for the third quarter. The company put on a masterclass of how to make $70 billion in 2 hours. And the way to do so, miss on deliveries, miss on revenue, and miss on brain cells, because that is exactly what happened on the Tesla Q3 earnings report. So the company came out and reported yesterday afternoon, Wednesday afternoon, Tesla delivered a total of $25.18 billion in revenue and earned 72 cents per share on that revenue. Now, the automaker did beat expectations on the bottom line for 68 cents per share, but they missed expectations on sales. Analysts were looking for $25.37 billion, so the company came up short by roughly, $190 million in total. So, all in all, relatively weak quarter on the revenue side, but you wouldn't know it at all. Now, let me go ahead and double check right here, because the last I looked, shares were up 11% after hours. Let me go ahead and take a look right here. Yep. 11.91% up after hours from 4 p.m. to 7:29 p.m., which it currently is right. Jesus, we've been going for a while. Holy shit, let's speed this up. So vehicle revenue was basically flat for the quarter. It was up, just about 1% or so compared to last year. But basically, it's been flat since Q3 of 2022, barely growing at all. Deliveries grew 6%, but it's really the pricing that's been a problem. Obviously, this goes back to, similar reasons to what we were talking about for the housing market. When you buy a car, you're probably taking out a loan to do so, and obviously if interest rates are triple what they were before the pandemic, that's going to hurt demand quite a bit. So again, this isn't just a Tesla problem, this is a automaker-wide problem. And the reason that you saw, a company like GM do well on its earnings is because expectations are so low in comparison to what analysts expect for Tesla. So again, deliveries up 6%. It's not necessarily a demand problem, but it is a pricing issue, which relates to demand because if there was enough demand, the company wouldn't have to give out as much discounts as it is, which is really hurting margins on the auto side, even though deliveries are still growing. So people want Tesla cars, but they're not necessarily willing to pay up for them, especially on their interest rate. So the Cybertruck was actually a bright spot in the quarter. This company has had more recalls than fucking raindrops hitting the vehicles themselves in the third quarter, but it still managed to do it pretty damn well. So they sold over 16,000 Cybertrucks, one of which was the 7 millionth car produced by Tesla, which they were all fucking hyped up about on their earnings call. So it was pretty good. And the Cybertruck unit actually delivered its first positive gross margin ever, so that was great to see as well. So it looks like the Cybertruck is adding a good bit of it's adding a new product, a whole new category to the automotive side. We'll see if the auto side, what I'm really going to be interested in is how that changes over the next 2 years or so with the automation side of things. But we'll get to that in a second. Meanwhile, Tesla's third largest unit, we're going a little bit out of order here. The energy unit grew sales 52% compared to last year, up to $2.4 billion. Now, this unit also achieved record gross margins of 30.5%. Its Powerwall had record deployments for the quarter. Now, total deployments did decline a little bit, but this is mostly a supply side issue. Now, we know Tesla's energy business, its biggest problem is that it has way too big of an order backlog. So the issue with that is that when you order something a couple of years ago, by the time that it might be ready to get delivered, maybe Tesla's already made a better version of that. And so it's like, do you want the one that you ordered, or do you want to just pay up for the better one, like at this point? So they've been facing some issues on the supply side related to backlogs there, but overall, all is going well on the energy side, and it looked pretty good on the services and other division. Now, this is mostly where Tesla is going to earn revenue off of non-warranty repairs and its supercharging network are kind of the two big revenue line items within services and other. Sales grew 29% annually to $2.79 billion. Deployments of the supercharger added 2,800 stalls in the quarter, and that was a 22% appreciation, also setting a record high right there. Meanwhile, full self-driving, Tesla's autonomous driving technology, crossed the 2 billion mile mark. So that means Tesla's FSD autonomous AI robot driving system has 2 billion miles of road data that it can work with. That absolutely blows away every other car. And the reason for it is because Tesla doesn't just have, a relatively small fleet of vehicles like Waymo does or something else, or one of these other competitors. Tesla gathers data from FSD for its entire fleet of cars. So, if you drive a Tesla, your personal car, when it's in FSD, it's sending data back to Tesla HQ and whatever they call that cluster of like infinity NVIDIA GPUs or whatever the fuck it is. So this gives them a huge advantage in the autonomous driving race, and after releasing the Cybercab and the RoboVan, which is apparently pronounced the 𝗪𝗏𝗡. I couldn't tell if Musk was trolling or what when he called it the 𝗪𝗏𝗡 during the actual launch event. We're going to remain sane over here and call it the RoboVan, but it's going to be especially interesting to see if, this actually helps gain some advantage in that market for those new products that are supposed to be coming in 2026 and 2027. But all in all, relatively good quarter for Tesla. Another key piece of things that was pretty interesting was the company earned $554 million in revenue from regulatory credits for selling electric vehicles. Now, that was record regulatory credit revenue, and the company still missed estimates on revenue. Now, once again, most of this is going to be due to weaker pricing on the automotive side of the business, but still, it's pretty weird that the company wasn't able to meet that expectation. Personally, what I would think from my perspective is that analyst expectations were just too damn high. Now, I don't know if that matters at all or if that, changes up your investment thesis on Tesla at all right there, but still, that's what it looked like for the quarter because the numbers overall were pretty damn good, and we can see that in the share price. It seems that analysts were like, all right, our expectations were a little bit high. We'll cut you some slack on this one, and we'll go ahead and give you a damn good day. So that about does it for us. We're just wondering if Tesla's plans for automations are actually going to come to fruition and what impact this is going to have on profitability going forward. So let us know what your thoughts are on that stuff. We'd always be happy to chat about that. I haven't gotten an email from anybody in like 2 days, by the way. So shoot me an email, david@wallstreetoasis.com. Just tell me how your day is going. Would love to chat with you guys. And otherwise, that about does it for us here today. Thank you, everybody, for tuning in. We absolutely love you guys. Happy investing, happy trading, and we'll see you tomorrow. Bye now.